How is bond interest taxed? Have you ever wondered how bond interest is taxed? This topic is essential for anyone involved in bookkeeping or financial transactions. Let's break it down step by step. First, bonds generate income in three main ways. The first is interest income, which is typically paid every 6 months. This is the regular payment you receive from the bond issuer. The second way is through capital gains or losses, which occur when you sell a bond before it matures. Lastly, there is the accretion of market discount. This happens when you buy a bond for less than its face value, and the difference can be recognized as income over time or at maturity. Now let's look at how interest income is taxed. For corporate bonds, the interest income is taxable at both federal and state levels. You need to report this income on your tax returns each year. U.S. Treasury bonds are a bit different. Their interest is taxable at the federal level but is exempt from state and local taxes. Municipal bonds usually have a favorable tax treatment. The interest is generally exempt from federal income tax and may also be exempt from state taxes if issued in your home state. However, not all municipal bonds qualify for this exemption, so it is wise to verify. From an accounting perspective, interest income is recorded as revenue when it is earned. This is typically done on an accrual basis, meaning you record it even if you have not received the cash yet. Next, let's discuss capital gains and losses. If you sell a bond before it matures, any gains are subject to capital gains tax. The tax rate depends on how long you held the bond. If you held it for less than 1 year, it is taxed as ordinary income. If you held it for more than 1 year, it is taxed at the lower long-term capital gains rates. If you incur capital losses, these can offset your capital gains, which can help reduce your taxable income. Now, what about the accretion of market discount? If you purchase a bond below its par value, you can recognize the discount as ordinary income. You can do this either over time, which increases the bond's cost basis, or at maturity or sale, when the entire discount is recognized as income. This choice affects your bookkeeping since the bond's carrying value must be adjusted annually to reflect the accreted amount. There are also special cases, such as U.S. savings bonds, which include Series E and Series I bonds. The interest on these bonds is exempt from state and local taxes but is taxable at the federal level. You have the option to defer reporting the interest until you redeem the bonds or they reach maturity. If you redeem them for qualified higher education expenses, some or all of the interest may be exempt from federal tax. When it comes to practical accounting and tax reporting, it is essential to record interest income when it is earned, even if you receive it later. For bonds purchased at a premium or discount, you need to adjust the bond's cost basis each year to reflected amortization or accretion. Tax forms such as Form 1099 interest or Form 1099 original issue discount report interest and original issue discount income to taxpayers and the Internal Revenue Service. In summary, bond interest is generally taxed as ordinary income at the federal level, with variations based on the type of bond. Capital gains from bond sales are taxed separately. Proper accounting for bond interest and any premium or discount is essential for accurate financial reporting and tax compliance.